Welcome back, ladies and gentlemen. My name is Joshua Castillo. If you haven't seen the channel before, it's because I haven't posted in quite a while. But I just wanted to kind of dive back into the content that I was doing before I moved and did a bunch of other stuff, hence all the background changes again. I just really wanted to dive into what I had so far in 2023, what I'm looking forward to in 2024, and continuing to really just get in on learning and trying to understand these markets and trying to understand how to invest and what I'm doing, and really just looking for ways to find money, basically. So finding $1 for 50 cents is what we're looking for. How do we do that and how do we identify it? That's kind of the goal of this channel. But with that being said, I want to give you an update on my portfolio because I haven't given one in quite a while, as well as this is kind of those things as far as transparency goes. That way you're not guessing if this is real or not, what I'm telling you. Although I guess you could just not believe that this is real either. But this is everything that I got. So let's dive right into 2024. Now, this is going to be through March as of today when I am filming this. So, you know, wherever the portfolio is where it lies. So here's the portfolio. We are currently at $27,463. You can see on the right side there, that's going to be the pie chart percentage of everything, basically. So cash makes up 34% of my portfolio. And part of that is because I'm trying to switch from, you know, putting 5% into companies rather than putting 10%. I'm looking to find bigger deals that I can actually put money into, or buying companies that I currently hold that are down. A lot of stuff's not down right now, so it's kind of hard to find stuff. But, you know, as you can see at the top, top center, right along here, the total portfolio return so far, just in total is $4,600, and that's over the course of almost 3 years now. So you can see the CAGR there highlighted, about 6%. Not great, but you're going to see why here in a second. It's sitting at 6%. We had a huge loss in 2022. Now, as far as, what we've realized, the unrealized gains and things like that, again, part of it is because of the fact that we've taken so much loss in 2022 that we realized, and some of the, gains that we have now are sitting in the portfolio, or actually sitting in at a, pretty sizable unrealized gain. So as far as everything else goes, you can see the investment performance, and I'm going to dive into line by line here in a second. But I just really wanted to show you kind of high level what that looks like, and also compare it to what it was in 2022. So in December of 2022, I don't think that this was the lowest the portfolio had gotten. I think Meta alone was down like significantly. And I mean, you can see it right here. It's down almost 50-60%. I think at a point it was down around 50-60%, and I had a lot. I think I had like 25% of my portfolio was just Meta. So for Meta to be down that much, there you go, right there, 48% is what it was at when I took this picture. So to give you an idea of what that looks like versus now, 162% is what we're at on Meta versus 48% really here. So it's been a wild ride, but I just wanted to show you perspective. Over the course of basically 2023, we went from negative $3,000 pretty much to positive $4,600. So that's some pretty crazy gains to have in a year. And a lot of it was just learnings and trying to get away from companies that I was investing into in 21 and 22. So continuing on, here is the portfolio. I'm not going to dive, line by line right this second, but I just wanted to show you kind of like on a broader level where we're at. So you can see as far as what makes up the percentage of the portfolio currently, Revolve and Meta make up about 20%, and then everything else kind of trickles down from there. Now, one of the things that I have as far as what you haven't seen probably, since I haven't done this in quite a while, we re-entered Revolve. That was kind of a big one. I know I wasn't like super heavy into Revolve when I did my last video. One of the puts that we sold back in, we sold it in June of 23 for a really, really low amount. It actually ended up hitting because of the fact that the company went under that price. So Revolve is currently sitting in the portfolio. It's up 25%. It had a huge update a couple days ago, so not surprising there. Meta, again, has been running like crazy, so not surprising there. Intel has gotten back to, where Intel was when I bought it, which is crazy because that was also down like 40 or 50%. Is down like, I think like $25 at one point. And JP Morgan has been ticking up and ticking up. Berkshire Hathaway, same thing. The new addition was PayPal. We have a 55 strike call on PayPal for January 16, 2026. That one I'll talk more about here in a bit. Dropbox, DJCO, BJ was also a new holding into the portfolio, and then Warner Brothers and Ulta, and then some calls that I sold at the bottom. So continuing on, let me just show you 2023 real quick. So the taxable income, again, I want to show you and be transparent as much as humanly possible. So you can see here the taxable income for 2023 was $624 in ordinary dividends, and then we had in net short-term, we had $659, in net long-term, negative $196. We sold $1,748 worth of options. And then let me go back to 2024. So far we've gotten $100 more or less in dividends, and then short-term $139, and then option sales, which you can see at the bottom of that revolve call, is at $29. So the option sales last year really made up a huge amount of the income that we had come in, because it's when you sell a put, you get the money. When you sell a call, you get the money. What happens with the shares and whether you buy the shares or not is determined by the price action. But really, I'm trying to use options and selling puts and calls to actually, make some money on companies that I want to own, or that, it gets to this price, I'm willing to lose it. So continuing on, here's the performance. So on the left side, we have the last 3 years, so 2021, 22, and 23. So again, you can see in 21, we were up 18%. In 2022, we were down 28%. Then 2023, we were up 40%. So it's not surprising, though, when you have, when you look at the indexes, you look at NASDAQ, S&P 500, they were also crazy runners as well. So it's not surprising that I'm up or down this much. I'm not that good of an investor, I promise. So when you look at that, just understand that where S&P 500 and NASDAQ actually were as well. Now, as far as what we're doing so far in 2024, you can see that on the right there. So year to date, we're up 3.7%. NASDAQ's up 8.1%, and the Dow Jones and S&P are up, 7.5%. So we're losing to the indexes right now, but again, it's for me, I'm making money, and I feel like I'm making money a little bit safer than I used to. There's still some stuff that I want to work out, still some stuff that I want to try, hence the PayPal call. But with that being said, before I get into the actual, companies that I own, I wanted to talk on the cash real quick. So when you look at the cash, I have 34% of my portfolio sitting in cash. It's $9,500. Right now, though, cash is making almost 5% 7-day yield on the money that I'm holding in there. So that is part of the reason I haven't been so, gung-ho on trying to deploy my cash, because, again, it's making 5%. If I don't have a deal that I feel comfortable in investing into, then I'm just going to hold and either wait for the price that I want or continue researching, searching through different things and trying to find deals that I actually like. So looking, though, at the stocks that we hold, I'm just going to do it this way because I couldn't figure out how to do it elsewhere. So let's just talk through where we're at with the portfolio, what we want to do, and how we want to do this. So as far as Revolve, right now, and again, I'll do videos for all of these as I can get to them. I did some research over the weekend on some companies that had earnings and kind of set up the PowerPoints for them, but I'm still working on some of the others. But as far as, where we're at, I'll at least talk about this in 2024 and going forward. So Revolve is a company of 10% of my money in right now, and they had a huge pop on their earnings the day after. The earnings themselves, like the net income statement that came out for Q4 2023, wasn't great. I mean, they beat their estimates, which is fine, but the actual performance of the company relative to what it did last year wasn't great. So this is one that I am currently watching. I think right now the sentiment going into Revolve, it's a very shorted company, so part of that price action was probably just due to the fact that people are covering shorts because of a small beat that turned into, a small short squeeze or something like that. I don't know if realistically, if that's where the, pricing in all the information that came out, if that really pushes it up 20%, 25% in a day. So that for me is one of those things where I'm going to hold it for now. And I'll get to, I sold a call, so we'll have to see what happens with that as well, because I may lose 100 of those shares just because of the fact that I sold that call. So I'm willing to lose it if that's what happens, but I'll have to see and research kind of a little bit more of what I want to do. But as far as 2024 and going forward, I think that this will be a year to turn around what they have been doing as far as growth rates go. A lot of it hinges on A, can they, reduce their cost to boost their bottom line? And then B, is the customer going to stay healthy and actually spend money, or are they going to pull back this year? So far, the last year and a half has been more or less like people taking out debt to go and use services rather than buying things. So if that continues on, we'll have to see. But I honestly, I'm not too worried about it. Next up, we got Meta. Again, Meta has been running. The sentiment switch is crazy. It went all the way down to $80 in October 2022, and it's been on a tear since. So I did, if you watched some previous videos, I did sell some shares of Meta. I think I had like 10 at one point. It made too much of my portfolio, and I like it. I was having a hard time sleeping at night, quote unquote sleeping at night, because of it. So just to minimize like the feeling I had about it, I just reduced the positions that I had. So obviously the returns look a lot better than when I sold it initially, because I had shares all the way up to like $300. So really it shows 171% here, but honestly, I think my cost basis was like high 200s. So, and probably closer to 300. So I'm not surprised that it's showing 171%, but realistically it is probably a little bit lower than that, just because I sold shares that were priced a lot higher. So now the only ones that are showing are the ones that have a cost basis of $180. But I am really happy with Meta. I like the turnaround. I like what they've done. I look forward to doing a video on it, because it's interesting from a value perspective where it's at currently versus where it was. And especially because of the fact that it was I think it hit it below a 10 PE ratio at one point. So that one's really interesting. I look forward to diving into that one a little bit more in a separate video. But right now, I think Meta's on a good path forward. It'll be interesting to see, just as far as valuation goes, whether it keeps its valuation or goes to a little bit more normalized valuation, which is a little bit lower than they're currently at. Intel, so this one from the get-go was really one of those companies that was in this long, trend of turning around. So it'll be interesting to me whether they can actually execute on what they're doing. So far, the news that has come out seems like the deadlines and the things and the timelines that they've been setting for themselves, they've been tracking to. There have been some delays, some, things that have been impacted, but overall, I think that Pat Gelsinger was able to put this company on the right track. Now the question is, because right now they're spending a lot of money, both net earnings and on their free cash flow, they're spending a lot of money and incurring a lot of debt to be able to build out this foundry services. So will the foundry services pay off is the question. Now they're going to get government money to subsidize some of the cost of that foundry. But, when it comes to establishing themselves and, getting customers, they're going to need to ramp really quickly and get a lot of volume into their foundry services. So that'll be interesting to see play out. But I think right now, I probably at the time overpaid a little bit too much for this. And I think that at best right now, it's probably fairly valued to maybe closer to overvalued versus, the current fundamentals. But again, the market is forward looking, so there may be a chance that what's being priced in right now is this turnaround play happening in full force. So there's not going to be like a sentiment shift for Intel, as far as it's now people are just waiting for them to actually perform. JP Morgan, what can I say about one of the largest? It's probably the largest bank in the United States, if not one of the largest. As far as banking goes, because of the way that the rates are structured and what's happening with the Federal Reserve right now, and really historically what's happened with JP Morgan, if the rate's getting lowered because something happens in the banking system, that means that JP Morgan might be one of those people to step in and buy. If nothing happens with the bank, they just keep making money. So it's one of those things where I got in during COVID and it was really low, hence the 50%, and it just keeps churning dividends, churning up the price action. And really, it's all going to depend ultimately for the banks in general on what happens with the Federal Reserve and when the rates are going to change and what that pivot actually looks like and what it entails. So I'm curious to see for this year what the Federal Reserve ends up doing. People were pricing in March as a first rate cut, and now it's getting priced into May. So it'll be interesting to see here in a couple of days what Powell says and how that impacts our banks as far as stocks go. Berkshire Hathaway, I feel like I don't need to go that deep on Berkshire. I mean, it's Berkshire. Like what what do you even need to say about Berkshire Hathaway that isn't already being said? One thing you can say, I guess, is the fact that they're making a lot of money as far as their operating earnings. So if you look at their operating earnings, this is probably on the higher end. If it was to average over years, this is probably towards the higher end, for their year, just because of how everything has played out. And a lot of insurance companies have been upping their rates significantly and getting the okay from the insurance generals within each state. So that's part of, when you look at Berkshire's operating earnings and trying to figure out whether this is sustainable or not, you have to take that into consideration and try to look through all the notes that were on the shareholder letter as well as through the 10K and understanding where the company is at. I think that at best, it's probably closer to overvalued, if not fairly valued. Somewhere in between there would probably be my guess. Obviously, if there's any pullbacks, it might be a good opportunity to buy if it fits your risk portfolio and fits what you want to do with your money. But I think that overall, Berkshire, for the most part, has opportunities over the years to be able to actually buy. So if it's not something you're willing to buy now, given the valuation, put it on the watch list, and you'll probably find that there will be a chance in the future where you'll actually get to purchase and own Berkshire Hathaway. PayPal. Now, PayPal is one of the companies that I have seen over and over and over again on value investing subreddits, on YouTube, on Twitter, on everywhere. It seems to be divisive as far as whether or not it's a value investment, whether or not it's an investment that you should get into, whether or not that it's even going to be a long-term player in the space. For me, the way that I look at it, I don't see it. I think one of the things that's dangerous is a lot of people are comparing it to Meta. They're saying, Meta did it from 22 to 23. PayPal can do it in 2024. And I think that looking at it that way becomes more of like a dangerous way of seeing it. Right now, the way that I see it is they have a new CEO. The trajectory that their CEO has put the company on is really good, and I like the way that they're moving. When they came out with their earnings recently, it almost seemed like what they were offering as far as guidance was more of like a sandbag than it did, an actual guidance. So it's one of those things where it's a conservative guidance. So if the company performs to a conservative level, they'll hit that guidance. If they perform how maybe Alex Chris probably thinks they're going to perform, it's going to be significantly higher than what the guidance is showing. So when you look at a company, though, like PayPal, it's kind of one of those things where they're going to need a couple of quarters, especially because the new CEO really came in Q3 2023 as far as, when he started operating. It was like right at the end of September, if I remember correctly. So he's got to get a couple of quarters of this turnaround under his belt and actually show that he can do it. And then the other piece of it is how do they monetize their platform without pushing people to other products? So PayPal and Venmo are kind of some of the bigger pieces of what they have as far as users and money made, but they also have some other brands underneath them that processes a lot of payments. So how do they extract value without completely screwing their customers is going to be the $1 million or billions dollar question that they're going to have to answer. But right now, I think it's probably undervalued to fairly valued. They're buying back shares. Alex Chris seems to have a good head on his shoulders. He came from Intuit, which is a really good knowledge base, as well as they've been bringing in some more higher level managers and directors to actually run the company that have some knowledge in this space that can push it into the next level. We'll have to see how this story plays out, but I really, really, really like this story. The only thing that I may do, depending on what ends up happening, I may switch this call for shares so that way I can just hold it, and without worrying about the interim price action, I can just worry about, do the shares make sense for what I'm trying to do, and does it fit my risk portfolio? I really wanted to see what a leap felt like and what it actually entails, and just kind of understanding it from the what it actually means for me and my portfolio kind of view. Dropbox, this one has been slowing down. I'll have to do a video on kind of my real thoughts and diving through all the different financial statements. But as far as valuation goes, this thing is selling for a very cheap, next year's price to free cash flow. I think the yield was somewhere around like 11%, 10 or 11% free cash flow yield. So while the outlook as far as how they're performing and the growth is slowing as far as their revenues go. But the way I look at it is that if I'm wrong about the growth, the value versus the growth and how that fits in, I still think that an 11% free cash flow yield will keep me safe on the downside. So maybe I don't perform, 10, 15% CAGR on this return, but maybe I don't lose money, which is the way that I'm looking at Dropbox. And that's kind of how I looked at it from the beginning. I never saw it as this like ultimate play that needs to be thought out and actually is going to grow like crazy. A lot of what they're going to have to do is figure out how do they churn through the, customers that they have. How do they keep the ones that they have? And then if there is a new product, if there's something that they can do through M&A, how can they bring that into their fold and actually product and market that to the rest of the companies that they serve? So I think that Dropbox for me, though, I'm going to hold it. I'm going to keep it in that portfolio for right now. Unless something fundamentally changes, the growth story right now is, the growth is slowing down, but they're buying back shares. They're using that free cash flow for their shareholders. So it'll be something to watch as far as what I think will happen. But I'm looking forward to seeing what actually happens with that story and how it all plays out. Daily Journal Corporation, I wish I bought more. This is one of those companies where my current valuation that I have for it is somewhere around like $300 to $315. That might still be too low as far as what the current valuation I think is. I have an order for it sitting at $315. I want to buy, double my position from 4 to 8, so that way I can have a lot more exposure to Daily Journal Corporation. But I think that this company is one of those things where no one's paying attention to it because when you look at a screener, it doesn't screen well. It has a big stock portfolio, and they have to show the unrealized gains and losses on their earnings. So now when you do a PE screen or you do a price free cash flow screen, it really doesn't screen that well. So when it comes to looking at this company, it's about the story and where it's going and how it's performing. I think that right now, in the way that they're performing and executing, I think Stephen Myhill-Jones was picked, handpicked by Charlie Munger, God rest his soul. But Stephen Myhill-Jones has his company on the right track, and I really like the fact that they're not broadcasting to the rest of the market what exactly they're doing. They just put out their SEC statements, put out their 13F filings, their 10Ks, 10Qs, and there's no earnings call. There's hardly a, daily journal meeting. There probably won't be live meetings anymore now that Charlie Munger is gone. So it's going to be one of those things where I don't think people are going to pay attention to it until it's too late. So that one for me is one of those things where I've looked into it. I've looked at the contracts. I like the way the contracts are structured. I like the way that they've ran the business. I like the way that the fundamentals are showing. I like the liquidity. I like the cash flow. So for me, I'm going to continue to hold. I really want to buy some more, but I'm not going to buy some more at these prices. I'm going to have to see what I can do to get something lower, but I'm willing to wait. BJ's, so BJ's Wholesale Club, it's a wonderful company. I think that I got in probably when it was fairly valued, so like around like low 60s, I think is closer to fairly valued. And for me, I think that this is one of those things where it's going to come through on how they deliver, returns to their shareholders and actually kind of follow that Costco model that, everyone loves as far as wholesaling, actually getting things to people. The thing that I love the most about the company's management team and what they highlight, everything that they talk about is what can we do for our customer? How can we help them? How can we benefit them? How can we get them to save money? And what can we do for them? Because ultimately that like short-term pain of not being able to maximize profits will ultimately lead to longer-term, customer retention, and it will lead to the fact that, this company is going to produce a lot more money when they have people subscribing to get into these wholesale clubs, which is similar to what Costco did. And the fact that they're able to negotiate deals and get people savings is fantastic. And it's really, for me, I just was listening to or I was reading through Richer, Wiser, Happier by William Green, and one of the things that Nick Sleep had talked about with Amazon was that if you can find a company that actually, focuses on the customer, gives savings to the customers, and makes the customer feel good, people are going to stay with that for a long time. And from what I've seen on a lot of the reviews on BJ's from, TikTok, Instagram, people like BJ's. So that makes me happy too. It's like one of those, it's hard to quantify what that actually means, but I think that qualitatively, I think they're doing a great job. And plus the fact that when you look at where Costco is held and where you look at where BJ's is held, they're not all in the same, especially the actual warehouses are not all in the same locations. A lot of them are actually, Costco's on the West Coast for the most part, and BJ's is mostly on the East Coast and kind of in the Midwest. So when you look at where they're located, there's a lot of growth expansion without competing directly with each other at every single corner, unlike Starbucks and like some other coffee joints. Warner Brothers Discovery, down 40%. It was down 50% not that long ago. This one is one of those where I believe the story coming in from the merger, and had I kind of realized what would end up happening as far as the debt goes and the fundamentals go, I probably could have avoided the 50% down. But this is one of those ones where I'm gonna have to reevaluate it when I have a second to really decide, and think about whether I want to add to this position since it's down so much, or just continue holding. I don't think I'm gonna sell currently. I still think that there's some room to turn this around, but as far as, whether I need to buy more or just hold, that is something I'll need to decide over the weekend and actually figure out whether or not this is something that I want to add to. It's only 2.91% of the portfolio, so while it is down 50%, I didn't expose myself to a lot of WBD, and that was intentional given the way that the merger happened and the way that the merger spinoff happened, as well as the fact that the fundamentals of the company. So I'm happy with the position sizing that I did do, but it's one of those things where do I want to add to it with the current cash that I have? Do I think I can get more in returns now going forward? That'll be the question that I'll need to look forward to. It went down quite a bit on the recent earnings, so that's one of those things where I'll have to see, really dive into the numbers, dive into the fundamentals, and figure out what I want to do with it. Ulta, honestly, at this point, I probably should just sell it because it's such a small percentage of my portfolio, but I have it in here. Originally, it was supposed to be a tracker stock. It wasn't supposed to be, something that ran up 42%, but it kind of did, and then I never got to add to it. So, when it comes to Ulta, I think the company is wonderful. I really wanted to buy more as it got lower, but I watched it bounce off 368 and then it went to 385, and I was like, I'm just gonna put a tracker stock on it in case it goes back down. It never went back down. It actually just kept going up. So I think it's probably closer to fairly valued or overvalued currently, but as far as a company goes, this is one of those companies that I want to add to if I get the chance to. So since the one share is up 42%, I'm not going to add to it currently, but I really do want to keep that as kind of like a tracker stock. If it does come down a lot, I'm going to, of course, put more money into that position. I really wanted exposure to Ulta and just the makeup industry as a whole, because I think that Ulta serves a really good market, and the people and the demographic that follow Ulta are religiously following Ulta. So moving on, these are the two calls that I sold. So WBD I sold a while ago. It's going to expire in January 21st, 2024. So a few months from now. Again, because of the fall of WBD stock price, it's of course, almost 99%, totally free and clear of me losing the shares. I mean, the strike price is $20. So unless WBD somehow manages to turn completely around in the next 4 months, I'm probably going to keep the shares, probably going to get the money from the call without having to have it sit in my portfolio. And then, I guess I already got the money, but I'm going to get rid of this off of my portfolio and see if there's any other calls that I want to sell. Might just have to wait for some volatility to be actually able to sell another call on these shares. And then again, Revolve, I had a $20 strike price that I sold when it was $16, somewhere around there, thinking, I thought that the sentiment was going to change, but I didn't think that it was going to run as much as it does. So right now, as far as Revolve is up to $21.42, and the strike is at $20. So if it stays over $20 next week, I'm going to lose the shares. Now, the debate becomes, do I want to just buy this call back and resell a call for the future that will basically cover the difference on the share price, or on the call price that I lost on this? So we'll have to see how that all plays out. Ultimately, as long as the shares are up, that sold call is going to be more expensive than what I bought it at. So it'll be interesting to see the price action over this week and pretty much into next week, what actually happens and what I end up deciding. But I'll keep you all in the loop. With that being said, though, I hope this was super helpful. As far as 2024 goes, I think that this is another year to continue to learn to buy stocks, to explore different ideas, and figure out what actually works for you. So I hope that me making these videos helps you explore another idea set. As far as what I want to do, I'm going to try to get back into the rhythm of things. So keep your eyes peeled for some more videos going through my portfolio, as well as some other companies that I have been looking into. And with that being said, thank you all for joining. Hope you have a great day. Happy investing.